All right, today we're jumping into a market that is so gigantic it touches everything you buy, every trip you take, and even the stability of entire countries. But here's the crazy part. For most of us, it's totally invisible. We're talking about exchange rates.
To get your head around just how massive this is, look at this number. That's $9.6 trillion. That is the amount of money that gets traded back and forth every single day. Think about that for a second. It's more than the entire yearly economic output of giants like Germany and Japan combined, and it all changes hands in just 24 hours. This thing dwarfs every stock market on the planet. It's the financial ocean we're all swimming in, whether we know it or not.
And the place where all this happens is the foreign exchange market, or what you'll usually hear called the Forex market. Now, it's not some big building on Wall Street. It's this massive, decentralized web of banks, corporations, and governments, all connected electronically, all buying and selling currencies around the clock.
So what exactly are they trading? Well, they're trading exchange rates, and an exchange rate is, at its heart, just a price. It's no different than paying, say, $2 for a coffee. In this market, you might pay 150 Japanese yen for $1 US. It's literally the price of one money in terms of another, and that price is set by the insane amount of buying and selling in that $9 trillion a day market.
So who is doing all of this buying and selling? You know, it's a huge mix of players. You've got your obvious ones, like a German car company that sells a bunch of cars in America and needs to turn its US dollars back into euros. You've got tourists, like a student from China who needs dollars for tuition and rent. Then you have the really big fish, companies making huge long-term bets by building factories overseas. That's foreign direct investment. And then the group that moves the most money by far, portfolio investors, who are zapping trillions around the globe buying things like foreign stocks and bonds.
Okay, but why do these prices matter so much to the rest of us? Because every time a currency gets a little stronger or a little weaker, it creates a very real list of winners and losers across the entire global economy. Let's break that down.
It really all comes down to two key words: appreciation and depreciation. When your home currency appreciates, it gets stronger. That means your $1 or your €1 can suddenly buy more of a foreign currency than it could yesterday. This makes foreign stuff cheaper for you, but it makes your country's products more expensive for everyone else. And depreciation, you guessed it, it's the exact opposite.
So this creates a kind of economic seesaw. Let's say the US dollar gets stronger. Who loves this? Importers. Because that French wine or that Korean TV just got cheaper. It's also great for you if you're traveling abroad. Your dollars suddenly have way more buying power. But it's a real pain for American exporters because their stuff just got more expensive for the rest of the world to buy. And that could put jobs in those industries at risk.
Now, let's flip that on its head. What if your currency gets weaker? Well, now the exporters are celebrating. All of a sudden, their products are a bargain on the global market, which can seriously boost their sales. The local tourism industry wins big too, because your country just became a much cheaper place to visit. And the losers? Well, anyone trying to import foreign goods, or, sadly, anyone who is planning that big overseas vacation.
So, we know what happens when these values change, but why do they change? What causes a currency to jump up one day and fall the next? In the short term, it's actually less about trading physical stuff like cars and wine, and way more about where big money is moving.
Day to day, the Forex market is totally dominated by those portfolio investors we mentioned. These are massive funds and individuals moving colossal sums of money around the planet, all chasing one thing: the highest possible financial return. They are constantly scanning the globe looking for the absolute best place to park their cash, even if it's just for a few hours.
And here's a perfect example of how that works. Think of it as a money magnet. Let's say the US central bank raises its interest rates. All of a sudden, US government bonds look way more attractive to global investors. But to buy those American bonds, what do they need? They need to buy US dollars first. This creates a sudden, massive rush of demand for dollars, which, you guessed it, pushes its price up. The dollar appreciates almost instantly.
The other huge short-term driver is something a little more psychological. It's pure expectation. If enough big-time traders all believe the euro is going to get stronger next week, what do? They all rush to buy euros today to get ahead of the move. But all of that buying pressure, right now, is the very thing that forces the euro to actually get stronger. It's this wild, self-fulfilling prophecy. We're just thinking something will happen, can make it happen.
Okay, so that's the day-to-day chaos. But let's zoom out from all that frantic trading and look at the big picture. Over months and even years, a whole different set of slower, more fundamental forces take control. And probably the most important of these is inflation.
The logic here is actually pretty simple. If prices for goods in, say, country A are rising much faster than everywhere else, their stuff just becomes less competitive. Fewer people abroad will want to buy their now expensive exports, so demand for country A's currency falls. At the same time, people in country A will start buying more cheaper foreign goods. That means they're selling their own currency to buy foreign ones, so you have less demand and more supply. And that's a recipe for a weaker currency over time.
This whole long-term idea is wrapped up in a famous economic theory called purchasing power parity, or PPP. It's basically the law of one price for the whole world. The theory goes that eventually exchange rates should settle at a point where a basket of goods, like a burger, fries, and a drink, costs the exact same in New York as it does in Tokyo, once you do the currency conversion.
Now, of course, the real world is a lot messier. PPP is more of a powerful magnetic pull than a perfect law. You've got things like shipping costs, you have taxes and tariffs at the border, and maybe most importantly, you can't really trade services like a haircut or an apartment rental internationally, so prices don't line up perfectly. Still, over the long haul, this is the anchor that currency values tend to drift towards.
So we've seen how these numbers can affect your wallet, your vacation, the price of your gadgets. But now let's zoom out one last time, to the highest level. Why do governments and central bankers practically obsess over these figures? Because the stakes can be enormous. We're talking about national economic growth, and sometimes even the risk of a full-blown financial crisis.
To really get it, you have to look at the basic formula for a country's entire economic output. It's GDP. See that last part in the parentheses, X minus M? That stands for net exports. It's simply what a country sells to the world minus what it buys from the world. And as we've already seen, exchange rates have a direct, powerful impact on both of those numbers.
Think of it this way. A stronger currency makes your exports more expensive and makes imports cheaper. This shrinks that X minus M number, which can act like tapping the brakes on your entire economy. On the flip side, a weaker currency can boost your net exports, acting like an accelerator for economic growth. This is exactly why you hear politicians talking about wanting a competitive currency.
But this isn't just about going a little bit faster or a little bit slower. For some countries, especially developing ones, a sudden, sharp plunge in their currency's value isn't just an economic headache. It can be an absolute catastrophe that puts the whole financial system on the brink of collapse.
This leads to a nightmare scenario known as a currency mismatch. Picture this. A bank in Thailand borrows a ton of money, but it borrows in a stable currency like US dollars because the interest rate is lower. The problem? All of its own loans and income are in the local currency, the Thai baht. Now, imagine the baht suddenly crashes. The bank's income hasn't changed, but the US dollar debt it has to repay just exploded in size. Suddenly, it's impossible to pay back, the bank risks going bust, and it can drag the whole system down with it.
Which brings us right back to the central puzzle. In a world where trillions of dollars can flash across the globe in seconds, driven by rumors and interest rates, what truly sets a currency's value? Is it the short-term whim of traders, or is it the long-term fundamental health of a country's economy? That is the billion or rather trillion-dollar question.